Well, good morning, podcast world. My name's Angie. I'm with Producers XL. Thanks for joining me this morning. It's obviously the last Tuesday of the month, so we're going to do a little bit of our podcast today. And I've got a sampling of things that I kind of wanted to talk about today around annuities and then hospital indemnity. It's been interesting. I've I can tell you, I feel a little, is discombobulated a word? I'm feeling a little frazzled this morning. When you have two IT people in your office and they're trying to figure out why you can't receive or send emails and they use the words corrupted and bloated, none of those sound like encouraging words. So, needless to say, I'm trying to get all of that sorted out. But there were a couple of things. The title of this podcast this month is called Hip Hip Hooray. And if you're in the Medicare space, you'll know that HIP, right, is kind of an acronym for Hospital Indemnity Plan. And you may say, Angie, I've really never gotten into them. And I will tell you, probably I haven't either. And maybe leaning into the Medicare space a little bit, right? When you're more in the Medicare supplement area, or maybe if your community is more of a med sup driven community because maybe Medicare Advantage networks aren't the strongest, or for whatever reason, maybe you don't believe in them. I'm not here to judge on that, but hospital indemnity plans are really kind of intriguing. And I want to first come out and say that Mutual of Omaha has launched a new one. I mean, we've got so many insurance companies out there where you can offer a hospital indemnity plan. So not necessarily promoting one over the other, but this one is a new launch. It's not everywhere. So even in my home state of Kansas, I don't even have an opportunity to sell it. It's kind of more in that Texas to North Carolina, kind of up in that string of areas. But what I think's really neat is if you're in the Medicare space, it's so bumpy. It's so, I don't know what words to use, disrupted, volatile, unnerving. I mean, it doesn't sound like there's a whole lot of positive things going on, but I think in the Medicare world, we have to understand that it's going through a little bit of an evolution, right? And we will get through this. If I could leave you with one bit of hope, Medicare will kind of right its ship. So the carriers are having to do some pretty big rate increases to do that. But why I want to talk about hospital indemnity a little bit, when you're talking about a Medicare Advantage, you naturally lean in. I mean, I don't think there's anybody out there that says if you're going to sell a Med Advantage, you have got to couple it with a hospital indemnity plan. It just makes sense because that's where their biggest copays lie, are in the hospital copays, whether it's 3 days, 5 days, 7 days, whatever that is, right? And this picks that gap. But you know me, I'm going to try to turn everything back to, so now I've touched Medicare, I've touched Medicare Advantage. Now I'm going to lean into long-term care a little bit. There are some hospital indemnity plans that if you're really thinking outside the box, it's going to be a medically underwritten policy like a Medicare supplement or a critical illness, right? Where it's not, but there are some really, really nice riders or add-ons that you can put on these hospital indemnity plans, right? So you can add skilled nursing facilities, you can add home health care, you can add lump sum cancers. There's so much like outpatient surgeries. I mean, nowadays you kind of almost do a whole lot of stuff via outpatient surgery. I not to get too terribly personal on you, but I ended up with a pretty extensive back surgery about 6 months ago, 7 months ago, and was in the hospital for 3 days. Ended up having some surgery on Easter Sunday. Apologized to the surgeon that we were both missing ham dinner with our families, and spent 3 days in the hospital for that. And I was just intrigued. I'm like, okay, I've got to see what this. So I'm watching EOBs come through. And if you actually go look at some studies that are out there on hospital stays, they say the average stay in a hospital, and this is going to probably blow your mind and you're going to be like, that can't be right, is $30,000 a day. It's exactly what it was. It's exactly what mine cost. My bill was over $100,000. Now keep in mind, right? Insurance kicks in, but it's really fascinating to me when you look at that. Most people aren't going to see bills that high. But then again, most people, if they had to pay $300, $400, $500 copay while they're in the hospital for a couple of days, that gets to be a lot, right? Now, all of a sudden, we thought was a premium savings. We're like, oh my goodness, I've got $1,000 or $1,200 or $1,500 out of my pocket. These things can really come in super handy, but also thinking outside the box. What if you have clients that just aren't going to buy long-term care insurance? They don't really want to have that conversation. I want to give you some samples. So a hospital indemnity policy for a 65-year-old female, just the base policy itself it's not even $11 a month. So this is not astronomical premiums we're talking about. You can add a nursing home, the skilled nursing rider to it that will pay $200 a day for the first days 1 through 20. And all you're going to do is increase that premium to $23 a month. And if you think about it, the average stay in a nursing home, right? Everyone's like, well, it'll pay the first 100, Medicare pays the first 100 days after a 3-day hospital stay, all of that definition. But the reality is the average stay before you become chronically ill is somewhere between 20 and 25 days. So if you had this policy kick in while you're in the hospital under Medicare, and it's going to pay you $200 a day, and then you have to go to skilled nursing and you didn't buy long-term care, of course, this is not the end-all be-all. Of course, this is not solving the problem. I'm only talking about thinking outside the box because some people aren't going to have that conversation. You can even add home health care. So now, right now you've added nursing home, you've added $200 a day for home health care, and you're still only elevating that premium to $55 a month. So it's still very affordable. And just, to be the knife salesman at the state fair, but wait, there's more. You can add one more rider to pay you $5,000 lump sum upon a cancer diagnosis, and now you're still under $70 a month. So they make these very easy, and I will tell you, so many of us are doing things digitally these days that the only way to actually quote it with Mutual of Omaha is on their mobile app. So it's click a button, add, click a button, add, click a button, add, and it just kind of tells you what the premium is. Um, I think hospital indemnity plans are probably overlooked. We should probably be looking at them a little bit more often. They're affordable. It's also going to allow people to get coverage when otherwise, right? So you can add you can fully load these things up. You can add ambulance services, outpatients, major diagnostic testing. You can add prescription drugs, which is not a replacement for your actual drug plan. But I would encourage you, if you're in a state that has approved the new Mutual of Omaha plan, take a look at it. Of course, if you have another company, the Aetnas, the Cignas that have hospital indemnities, by all means. But I think it's important that we start talking about this and to get back into that Medicare industry, right? With so many of this stuff really not coming in with paying commissions, a lot of agents are really scrambling to try to figure out, how do I keep doing what I love? I love being in the senior space. I love helping these folks. The gratitude that you get from the seniors that you're helping navigate through that prescription drug and the Medicare Advantage maze that goes on. It's endless. They are so thankful. And I know all of you could tell me that they've said, what do I owe you for this? And our answer is you owe me nothing, right? I get paid a commission from the insurance companies. Well, there's an awful lot of you that are calling me, especially now that we're rolling into certifications and getting ready for AEP and finding out what we can and can't do and starting to see some of the first looks and who's going to pay commissions and who's not. And you're like, I still have to do what's in the best interest of my client. And maybe the majority of that is on something that you're not going to get paid a commission on. So I'm not saying that we start looking for other things to cross-sell to fill that gap, but we all know that there are gaps in Medicare, especially when somebody becomes chronically ill and they're needing some extended care. No, of course, hospital indemnity, critical illness policies are not the solution. I believe everybody should be educated on long-term care insurance, because without an education, you can't make an educated decision. But it is certainly our due diligence, our what we do as agents. It's our responsibility, even though it can be overwhelming to the client, but we've got to somehow find a smooth way to enlighten them and educate them on these gaps, without them feeling overwhelmed, so that you can bring up a lot of these conversations that just need to be addressed. All right. They have a right to say no, but they can't say no if you don't give them that opportunity. So the other thing, and this is going to feel a little bit like the Mutual of Omaha show, but the other thing I really wanted to talk to you about was they just launched a new fixed indexed annuity. And Kayla, our annuity director. Love that gal. She's out on maternity leave right now. If you work with Kayla, send her a congrats. She finally had that little baby girl, and let me tell you, she is beautiful. She's our annuity director, and so she's out on maternity leave, and so I'm monitoring her emails and trying to do my best to fill the void while she's gone. And what's interesting to me is I've kind of started. It's interesting when you talk about fixed indexed annuities. I either get, obviously, the financial advisors that have to do their index products through their broker dealer. Right, we totally understand that. For those of you that can do index with us, or through your current BGA, it seems like there's a definite line in the sand on how you feel about indexed annuities. I'm not here to try to sway you one way or the other. I just had a conversation with a gentleman who bought a fixed indexed annuity as an agent himself, and he's not happy with that. There are a lot of moving parts with fixed indexed annuities. You need to understand that, right? But the whole concept is upside potential, no downside loss. Zero is your hero, whatever those acronyms are that you want to say. But not trying to explain or convince you that you should sell fixed indexed annuities. I do, however, want to bring up the topic of this particular one because I had a really unique situation come up the other day. It was a young gentleman. An agent called me. She had a young client, maybe early 40s, wanted to pull some money out of his 401k, if not all of the money that he had started in his 401k. So obviously it wasn't a lot, and wanted to put it into an annuity. And of course, fixed indexed is where she wanted to go because she wanted the upside potential. He had time to just let that thing sit and bake. Got me thinking about this one. Not that it couldn't be useful for older ages, but this particular gentleman was younger. And it's your typical fixed indexed annuity, right? You can do a 3, 4, 5, 7, and 10 year. It will go down to a minimum of $10,000 for qualified or non-qualified. What I thought was interesting is it does allow for some minimum additions during that first policy year. Does issue up to age 85. If you're going to do a 10-year, it's only up to 80. The one thing it does offer that I thought was very unique is a couple of, and I'm not going to get into indexing strategies because they've got plenty, just like every other indexing annuity or indexed IUL. They all have their own indexing strategies, right? That's a whole conversation for another day. But the waiver of withdrawal charges, and this is where I thought kind of set this one apart, and I thought it was very unique in this aspect. Let's just say you have some of those younger clients, maybe not in their 40s, but younger-ish, right? It will waive the withdrawal charges for several different things. So when I tell you confinement to a hospital or long-term care facility, maybe not so unique. I've seen nursing home waivers on others as well. There's one on unemployment, right? So I could see that coming into play for younger folks. So if you've gone at least 2 months, 60 days of being unemployed, you can actually get access to your funds without any withdrawal charges. Disability. I don't know that that's necessarily unique, but after 90 continuous days of disability, you can actually have access to your funds. So I like that. There's also a terminal illness. The next two specifically, they also have one for transplant surgery, right? So if you undergo a transplant, you can have access to your funds without withdrawal charges. But these next two I thought were really intriguing because to me, this is kind of crisis. When crisis occurs, sometimes everybody's just in need of getting their hands on some cash. And with some folks, right, if it's not their home equity, it's in their retirement account. So how do they get access to that? Well, this one also offers a waiver of withdrawal charges for the death of a spouse or a minor dependent. So the ability to be able to go in there and surrender, 50% for if a spouse passes away, to get your hands on some of that money without a withdrawal charge could be really, really important. I know all of you could probably step back and have gone through it yourself, or have experienced family or friends go through it where the finances just weren't, as they say, the house wasn't in order. But yeah, we've got this annuity sitting over here. It's got qualified funds or it's got non-qualified funds in it, and the spouse passes away. And we're grappling with, one, how do we even pay for this funeral? Where do I get the money to do that? And then maybe where do I get the money to pay off some of these outstanding medical bills? Or how do I clear some of this so I can breathe? I still have the kids, I'll figure out, am I staying in the house? I mean, we've all seen that play out in real life. So I think sometimes these writers really do become very relevant with certain clients. Again, like I said, it's not for all, but certainly could apply. The other one that I thought was interesting was damage to your residence. And it dawned on me, like, I think it was 2 or 3 years ago, we had a big wind and hailstorm that came through our hometown out north of town where I live. And we had like over $70,000 worth of damage to our house due to the wind and hail, which I'm still going to partly blame for my whole back problem, because we spent an entire Sunday picking up logs and sticks from our yard. But it basically says here, if you have physical damage of 50,000 or more to your primary residence, they will waive the withdrawal charges and you can get access to funds. So maybe that's because you've got to pay your deductible, or you've got to, grab some funds to be able to immediately pay for. I don't know. I'm just thinking about all the things that I've seen friends and family go through. I mean, not that this is the situation that you want, but maybe they're tapped out on credit cards, or they just can't get their hands on money, and they've got this small annuity sitting over here and they just need a little bit because their house has been decimated by a tornado or who knows what, and they need to go hold up in a hotel before they can actually get into some temporary housing, whatever the case is. But I thought some of these writers were very interesting and could be applicable for the right client. And like I said, it was just a happenstance. I was working on an indexed annuity for another agent. And then they launched this, and I immediately picked up the phone and called her back. And I said, this might be something, this could be a nice, oh, dang it, life just happened. I need my hands on some money. We can waive withdrawal charges and get some access to that money. So those are some of the things that I wanted to mention to you. This one was kind of a quick and easy little podcast that I wanted, but some things that I thought were relevant. Of course, if you're interested or you want to have a conversation, my email is angie@producersxl.com. Phone number here is 800-541-6705. I'm always looking to make more friends. If you want to have a conversation about the life insurance space, IULs and overfunding for cash accumulation for loans. I mean, there's just so much going on in the industry right now that it just feels like there's really no conversation off the table. And so I thank you for joining me this month. August, can you believe it? We've got Labor Day coming up. Hopefully you all don't labor too hard on Labor Day. I want you to enjoy the weekend, rest, because in my mind, when we come back from Labor Day, that's when everybody gets back to work, right? You're going to get back to work, and then we're going to kind of slowly work our way into the holidays. So thank you for joining me. My next podcast is September 30th. I will come up with some topics that we're going to have then. That's also when my travels start to pick back up again. So we will certainly make things exciting for you then. Thank you very much for joining me, and I appreciate all of you tuning in. Take care.